welcome to Finforall by Jupiter. My name is Dipansha Dhingra and today we are going to discuss best stock market portfolio for beginners. When it comes to investing, we get a lot of yarn from everyone around us. Especially if you're just starting out, stock market is a very confusing topic. You want to make the best use of your money and get the best value out of it. As they say, starting early is the key to maximizing profits. So if you're watching this video today, we are sure you want to hear some kachings pretty soon. There's of course no recipe for guaranteed success. Stocks crash, investors lose money. So there are a few things to keep in mind before you begin. Number one, gauge how much you are willing to risk. Losses are sometimes inevitable, but you should have a clear mindset about where you draw the line. Number two, keep your portfolio diversified. What that essentially means is just because a stock is doing extremely well does not mean all your principal must go to it. You should also invest in some stocks that are steady even if not glamorous. That way you are much more likely to have stable profits down the line. Asset allocation is a crucial first step to this marathon called investing. Number three, know how long you want to stay in the game. As a rule of thumb, if you're looking at say up to 5 years of investing, you may want to go large cap to maximize profits. While for 10 years and beyond, investment in small and medium cap shares can help create long-term wealth. Now let's jump into 4 kinds of funds that make a good beginner stock portfolio. Number 1, index fund. Index fund is basically a mutual fund that mimics a stock market index like Sensex or Nifty. When we say mimicking, it means both in terms of the kinds of stocks and the weightage of each stock is imitated from the underlying stock market. As a result, it provides returns close to the industry benchmark. Another advantage of an index fund is that your principal is invested in a variety of stocks across sectors, making it a hugely diversified and balanced portfolio. If we look at some historical data, the average 3-year returns of 10 of the best performing index funds in 2022 is about 15%. In terms of risk, most of the index funds offer a relatively safer choice for investment. Number 2, growth stocks. These are high-risk, high-reward kinds of stocks. Growth stocks are the ones which are expected to yield a much higher return than the average company within the same sector. One recent example can be the boom of pharma companies during the pandemic. Industry benchmark classifies a growth stock as the one whose 3-year returns are greater than 40%. Number 3, value stocks. These are in a way the opposite of growth stocks. These are the stocks investors think are being underestimated by the market and their current price is less than their intrinsic value. Sometimes due to market fluctuations, a stock may not currently be performing as well as the company's historical benchmark, in which case it will be available at a much lower price at the present, but will yield results in the long term. Value stocks are low-risk stocks due to the fact that they are already at a lower cost when you buy them and are not expected to go down further. Number 4, blue chip stocks. A blue chip is a stock in a company which has reputable, stable and dependable earnings over many years. In many of these, dividends are paid to investors. Their growth may appear to be low but stable, which is very helpful to downsize the risk of your portfolio by investing in healthier, long-term options and receiving regular income rather than a massive lump sum profit. Here, understanding dividend yield stocks is also important. These are the stocks that provide a higher income as dividend than the industry benchmark. Dividend yield is calculated as the ratio between the annual dividend per share and the current price of the share. Suppose the dividend yield of a stock is 20%. It means that you receive Rs 20 for every Rs 100 that you invest. As per industry standards, a dividend yield of 2 to 4% is considered good, which might not seem like much. It basically means you get 4 rupees for every 100. But dividend yield stocks are also a constant source of income, meaning even when the market goes down, you will still receive your 4 rupees in dividends. As you start building out your portfolio, a few guardrails can help you out. Please remember that these numbers are more of an FII or a model framework. You can shape your portfolio as per your risk-taking appetite and experience. Number 1, don't invest less than 4% and more than 10% of your capital on a single stock. These are not golden numbers but rather a safety net in case things don't work out. Number 2, don't invest more than 25% of your capital in a single sector. Like we mentioned earlier, the pharma companies are booming at the present, but that does not mean the market will always be favorable to this sector. Number 3, try to invest at least 5% of your capital in alternate assets. Alternate assets are the ones which are almost unrelated to your equity-based portfolio and often work in the opposite direction to your usual stocks. These assets can be in gold commodities or even real estate. They allow your portfolio to be even more stable by countering major market losses. In a nutshell, club together some high-risk and low-risk stocks to balance them out. Depending on your experience and understanding of the market, you can alter your investment in passive and active funds. If you want to chill out and not actively worry about your money, index funds can greatly help. If you're more active in the market and want to go for higher returns, growth stocks would serve as a great option. Nevertheless, even the best of investors are wrong sometimes. So don't worry about short-term market fluctuations. Until next time, thank you for staying tuned. For more on finance and everything beyond, follow Finforall by Jupiter on YouTube, Instagram and LinkedIn. Don't forget to leave a like and share your views in the comments below.